Hello, my name's David Miller. I'm the manager of Nexus Global Solutions Portfolio and the co-manager of Dynamic. I'm speaking to you from London in early January, and so to start with, my best wishes to all for a prosperous new year. Welcome to the third decade of the 21st century. Well, last year was a very good year for investors. Markets turned around Christmas of 2018 when it became clear that interest rates were not going to go up any further. In fact, they were going to go down. The best decision we made was to buy the dip. And as a result, Dynamic over the year produced a return of about 23%, and Solutions, the more diversified portfolio, up by 14%. Both best returns ever since these portfolios were set up in 2013 and 2014 respectively. And in December, there was that final push up higher with Dynamic up 3% and Solutions 1%. We made some changes to asset allocation for tactical reasons during the period, but broadly speaking, what we had worked. So, what went right last year? Firstly, interest rates, as I said, stayed low, and that proved a powerful driver for markets. Economic growth was positive, not spectacularly, but good enough. And inflation critically stayed low, which meant that central banks didn't feel any need to push rates higher. That was really the cornerstone of the market, and we, as investors, took full advantage of that. So before I move on to the future, why was December good? There were some notable events. We had a UK general election, and this time, to the surprise of many, the polls were right. But in fact, investors, if we look at the markets as a whole, moved to discount the Conservative majority ahead of the event. We had a relief rally on the day after, but it was all over by 9 o'clock. Essentially, after that, it was back to business as usual. Same for the US-China trade dispute. A little bit of better news in December certainly didn't go amiss. The truce seems to be holding for the moment, but watch this space. It really put pressure on those who were not invested. Those of us that were invested were able to benefit from that, and that includes all investors in Solutions and Dynamic. In terms of stock selection, it was a broad range of winners in the last month, ranging from Apple to Tesco to Roche. These are diversified portfolios. We don't have any particular style bias, as people say. We're looking for good companies, and that's what made the difference last year. Stock selection generally added value. Picking the winners matters, not buying the losers, and this sounds so obvious, is also part of what we do. And that is why the reports I've reported have been so good. So the future, that's what's important now. It's nice to look back and celebrate last year, but what are we going to do next? Well, to start with, I think it's business as usual. As I've said, the environment is going to continue as it was last year for the moment. What will matter is that we have sustained economic growth. It would be nice to have a little bit more. It's the early days for the year. We'll monitor the results and the statistics as they come through. Then stock selection again will matter. It's not just about buying the index, it's about buying the right companies. We will continue to spend all our time on trying to select those companies, making sure that the portfolios are positioned to benefit. And the cornerstones of the portfolios will remain in place. What are they? Quality, liquidity, and diversification. And when I say diversification, I mean asset allocation, stock selection, geography. All of these things go into the mix to delivering a risk-adjusted, sensible investment strategy where investors benefit from upside and where we do our very best to protect on the downside. So I hope that's been a useful primer for 2020. I look forward to reporting to you again in a month's time. Thank you.